When markets crash, most investors panic. They check their phones at midnight, refreshing charts and scanning headlines for clues or comfort. They scramble to sell, hoard cash, or chase assets that feel safe, but aren't really safe at all. And some people don't flinch. Not because they're reckless, but because they're structured. They don't see a red screen and assume disaster. They see a revaluation, a reordering, an opportunity to step forward while everyone else steps back. And the way they prepare might surprise you. Imagine the market as a storm. Most people run for cover, but the wealthiest families? They've already built the shelter and stocked it with tools to build while others are still rebuilding. Take the 2020 market crash. While the S&P 500 plunged over 30% in weeks, many investors rushed to de-risk, even as a segment of capital quietly moved in to seize opportunity. They deployed into distressed credit, warehoused secondaries, and even acquired public companies off-market. These weren't gamblers, they were prepared. They didn't need to make decisions in the chaos because the real decisions had already been made, quietly, long before the storm hit. This isn't about timing the market. It's about removing yourself from its emotional gravity. For the ultra-wealthy, family offices, institutional allocators, legacy-minded investors, a crash isn't a surprise. It's an expected variable. A feature of the system, not a bug. They're not asking, how bad will it get? They're asking, are we positioned to move while others freeze? Volatility for most investors feels like risk. But for those managing generational capital, volatility is information. A signal, not a threat. Here's the key difference. The average investor reacts. The ultra-wealthy restructure. This isn't about being contrarian for the sake of it. It's about building a system that can operate independently of public panic. They don't rely on public markets for liquidity. They've already structured for downside protection. And they don't see market crashes as catastrophes. They see them as repricing events. While others gasp for air, they're already holding the oxygen tanks. Most investors are overexposed to public equities, so when markets drop, their perceived net worth drops too, triggering emotional decision-making. But the wealthy often hold a very different mix. Private equity, private credit, long-duration real estate, and operating businesses. According to Capgemini's most recent World Wealth Report, high-net-worth individuals have been steadily reducing their exposure to public equities, while increasing their allocations to cash and equivalents as a strategic buffer, not a panic reserve. When the public market sneezes, the wealthy don't want their liquidity strategy to catch a cold. Some build liquidity systems that function independently of public market volatility. These might include lines of credit collateralized against private assets, life insurance structures with liquidity access, or cash flow from private operating companies. These kinds of strategies give them the flexibility to act when others can't, and avoid being forced to sell at a loss. Let's pause here, because this is the difference many investors are learning to recognize. It's not about having more capital, it's about having a structure that enables action without pressure. For those focused on long-term capital preservation, risk management isn't reactive. It's engineered up front. Some of them hedge using options or volatility overlays. Others diversify into uncorrelated assets like litigation finance, timberland, or royalties. Insurance-backed capital structures, like premium-financed policies, are also common in certain circles, providing both protection and optional liquidity. These aren't recommendations, just observed patterns from within the family office and institutional investing world. Beyond asset mix, many build psychological insulation. They define their maximum acceptable loss before the crisis ever hits. So when the storm comes, they're not guessing, they're executing. A $20 million portfolio with 50% in illiquid alternatives won't behave like a $2 million portfolio fully exposed to tech stocks. The difference isn't wealth, it's architecture. According to UBS's latest Global Family Office report, a majority of family offices are increasing their allocations to alternatives as concerns over public market volatility continue to rise. Today, alternatives, including private equity, infrastructure, and private credit, make up around 45% of the average family office portfolio. Public equities? Just 26%. Market crashes don't just destroy value, they reveal it. Some investors see a downturn as a liquidity premium reset, a window when assets are mispriced due to fear, not fundamentals. Distressed debt may trade at 60 cents on the dollar. Venture secondaries are sometimes offered at 40 to 50% discounts. Operating businesses under capital strain may offer favorable bridge financing terms to outside investors. These aren't moments of panic. They're windows of asymmetric opportunity. That's why many ultra-wealthy investors maintain dry powder, committed capital that's reserved for dislocations like these. It's the difference between being forced to sell and being invited to buy. Consider two hypothetical investors. Same capital, different positioning. Investor A holds 90% in public equities and 10% in cash. Investor B is structured with 40% in private credit, 30% in secondaries, 20% in public markets, and 10% cash. When a crash hits, Investor A sees a 25 to 30% drawdown and feels cornered. Investor B experiences a dip in public holdings but sees income stability from illiquid assets and uses dry powder to move on distressed deals. Investor A is reactive. Investor B has options. That's the difference between exposure and insulation. True wealth isn't just about maximizing upside. It's about protecting downside without surrendering the ability to act. Tiger 21's member allocation reports show that private equity now accounts for roughly 29% of ultra-wealthy portfolios, an all-time high. Public equities are down in the 19 to 25% range. The shift is clear. Less tolerance for volatility, more emphasis on control and structure. The Yale Endowment didn't outperform by picking better stocks. They stepped out of that game altogether, with over 75% of their portfolio in private markets, real assets, and uncorrelated strategies. They didn't panic when public markets melted. They were positioned not to. It's not a secret, it's a different operating system. Still, most accredited investors won't get access to these kinds of opportunities during a crash, because access often depends on decisions made during calm. In those moments, structure outweighs status. If your liquidity is tied directly to public market valuations, your options shrink when volatility rises. This doesn't mean public markets are useless. It means understanding their role and their limits. A crash shouldn't dictate your strategy. It should test it. The wealthiest investors don't succeed during crises because they see them coming. They succeed because their strategy doesn't rely on prediction. It relies on structure, insulation, and positioning that isn't emotionally reactive. They have decoupled liquidity from emotion. They've separated strategy from sentiment. And above all, they've built systems that don't require them to act under pressure. That's why many of them emphasize dry powder, not as idle cash, but as an instrument of flexibility. It buys time. It opens doors. It unlocks opportunities that simply don't exist when you're fully deployed and emotionally stretched. Most families don't lose wealth in downturns because of the crash itself. They lose it because of what they do next. Panic selling, chasing false safety, or scrambling for liquidity that should have been planned for long ago. The rich don't avoid volatility. They anticipate it, prepare for it, and often use it. So the real question some investors ask isn't, what will I do in the next crash? It's, what will my structure allow me to do? Because resilience isn't just a mindset, it's a blueprint. And it's one that many of the world's wealthiest families have been refining for decades, through endowments, family offices, private structures, and long-term allocation models. not to beat the market, but to remain sovereign within it. If this kind of structure interests you, we're just getting started. We share stories about how capital gets organized when volatility is the norm, not the exception, and how some investors build systems that don't need to guess at all. Smart modern wealth sees opportunity where others panic. You've learned to profit from crashes, but here's the thing. The ultra wealthy don't even bother with this anymore. They move their money where crashes don't happen. Private deals making double-digit returns every year. We'll show you where they went. Watch now.